UN predicts slow economic growth in 2026. Moody warns Trump defense budget plan could widen deficits. And Italy to spend around €1 billion to curb energy bills. Well, good evening and welcome to our new Economic News Bulletin. And we start off with global projections as the United Nations has forecast global economic growth to decline to 2.7% in 2026 from 2.8% last year before increasing to 2.9% in 2027, still down from the pre-pandemic average of 3.2% between 2010 and 2019. Is slowly projected global inflation to decline to 3.1% in 2026. In its World Economic Situation and Prospects report, UN also projected global inflation to decline to 3.1% in 2026. It said that although higher US tariffs in 2025 raised trade tensions, the lack of broader escalation has limited disruptions to global commerce. The report also forecasts economic growth in the United States to edge up to 2% in 2026 and 2.2% in 2027, aided by expansionary fiscal and monetary policies. Moreover, in China, the economy was projected to grow by 4.6% in 2026 and 4.5% in 2027.
We project economic growth to stabilize at 2.7% this year, compared to 2.8% in 2025. Last year, sharp tariff hikes disrupted global trade. Yet the system proved more resilient than anticipated.
Inflation, which has been a bugbear for a while, has also been falling globally and is projected to decline to 3.1% in 2026, continuing the trend over the entire year last year, where it was at around 3.4%. Trade growth remains solid, and among other broadly beneficial developments are a global trend towards monetary easing and improved cross-border financial flows.
Of the report, I regret that I will also have to leave.
Moreover, the United Nations Food and Agriculture Organization has reported that world food prices declined for a fourth consecutive month in December, mostly pressured by dairy, meat, and vegetable oil prices, marking the lowest average since January 2025. FAO Food Price Index, which tracks a basket of globally traded food commodities, averaged 124.3 points in December, down from 125.1 in November, and 2.3% lower than a year earlier. For the full 2025 year, the index averaged 127.2 points, up 4.3% from 2024, as higher world prices for vegetable oils and dairy products outweighed declines in cereal and sugar quotations. In the same vein, the World Economic Forum has reported that companies face greater challenges in 2025 due to weakening global cooperation on trade, climate, technology, and security. A survey of 799 executives across 81 economies found 43% said doing business became harder compared to 2024, while only 7% disagreed. About 40% cited rising barriers to trade, talent, and cross-border capital, though 60% did not see trade as a major issue, suggesting many have adopted their strategies to navigate the turbulence. The report also noted that global investment in renewable energy grew nearly 10% in the first half of 2025 compared with the same period in 2024. For further analysis, we are joined from London by CEO of the QW Capital, Mr. Gianluca Lobafello. Good evening to you, sir, and welcome to Qnews and to our economic bulletin. And let me start by asking, how does the UN's projected decline in global economic growth to 2.7% in 2026 from 2.8% in 2025 impact emerging markets' access to international capital flows and commodity demands?
Yeah, that's very interesting actually, because clearly the report of the UN is not far from general consensus. Everybody is expecting a marginal decline. I mean, from 2.8 to 2.7, we're talking marginal decline. Well, what is interesting of that is that obviously the real big gap is versus pre-pandemic level, as you said in your introduction, where more or less we stand around 3.2%. That was driven particularly by stronger growth in China. Specifically China, of all the area that the UN analyzed, so US, Europe, Southeast China, and in Southeast Asia, India, China, and the emerging market, the only country where it doesn't see as marginal recovery in 2027, so slowdown in 26 and continuous slowdown in 27, is actually China. Whereas for US, Europe, and particularly India, it sees a marginal recovery in 2027. That is actually the same reason why pre-pandemic we had the 2.2%, because the area of US, Europe, India, we are not saying a major change versus pre-pandemic. The real difference is China, that is assessed to be around 4.5%, whereas, as you may remember, before the pandemic, normally China was almost in double digit. If it had a growth of 8 to 9%, it would have been a disappointing year. Now we are talking about 4.5%, is actually considered a good number. That's fair, but that is the reason why we're seeing this slowdown. Obviously, it goes along with again, what you said in your introduction, with the World Economic Forum, who is focusing with this business barometer on the difficulties in doing business 2025, they very likely will persist in 2026. It won't worsen, but definitely will persist. Don't forget that, yes, tariff hasn't been as bad as announced. We didn't have huge retaliation by other countries, but don't forget that if we look at what was the average level of US tariff between December 24, so before the new tariff, and what we have now, current, so December 25 or January 26, we moved from an average of 2.5% to an average of 14.5. So 5.8 times, 6 times more. That's obviously has an impact on any company who depends on frictionless global transaction. So there is a lot of regulatory implication or fragmentation. So that's clear. That's an impact.
Right. And definitely those wars and insecurity have already disrupted the chains of supplies in many areas. Now, how will weakening global cooperation on trade, as reported by the WEF, exacerbate the UN's projected slowdown to 2.7 growth and pressure cross-border supply chains?
I mean, this is clearly, don't forget that we are looking now from an economic perspective, makes sense, but the core of all this is a new geopolitical equilibrium. We have seen recently what happened in Latin America with Venezuela. We are seeing all the tension with Europe. Don't forget that Europe used to import gas for 42% from Russia, and now this has been replaced at least 30%. So out of 42, Russia now we're importing only 12%. And that 30% has been replaced by liquefied gas from the US, who costs between 4 and 5 times more. So these have implications on the European industries. And obviously part of them will be replaced from import by import from Northern Africa, but it's a process. We are seeing a new reequilibrium. We are no longer seeing this multilateralism, global multilateralism, but actually agreement among smaller group. So you have the Western Hemisphere, as Trump was saying, they will have implications. They will have reassessment. We don't have any longer a globalization. It's fair to say that the globalizations we have seen in the last few years was not particularly good, was not balanced. So globalization is better than the stuff tariff and protectionist for sure, but let's not forget that the free globalization completely, let's say, spoiled by, for example, the role that China has as an emerging market classified, so you can intervene on the foreign exchange, is creating so many problems, the industrialization of Europe and the US. So globalization as it was in the last 10 years is not the answer to this problem. A balance, a fairly market-driven globalization, yes. Something we have seen in the last 10, 15 years is not the answer.
So with global inflation easing to 3.1%, what constraints from the World Economic Forum noted cooperation gaps in climate and technology might limit private investment recovery?
Yeah, in reality, the lower inflation or the not picking up of inflation, bar Japan, where actually inflation is still increasing, is a good news. So in theory, this has been enlisted by the World Economic Forum, but not necessarily as a headwind. I would rather consider this as a tailwind, along with infrastructure investment into technology for supporting AI or for defense and cybersecurity. The problem is, so what they call it headwind are actually all to do with this more protectionism. It's given that all the company who benefit out of frictionless transaction, definitely they will have pressure on their margin, and so they will be less prone for investment, and so less GDP growth coming from them. But on the other side, we have huge investment in infrastructure, in energy, in cybersecurity, in defense. Don't forget the 800 million package in Europe, and this is here to stay, without looking at obviously the reason for war that not morally justified, but just in terms of economic impact, this as a positive, so tailwind for GDP growth, tailwind for business to be executed in this group, in this economic area.
Right. What implications does the 2.1% growth forecast for the CIS countries hold for commodity exporters, bond spreads, amid ongoing Ukraine-related disruptions?
Yeah, this is very, we'll have a lot of dispersion in this area. It's very difficult to classify as a one group, because when we have period like this, where again, there is no globalization, there is only one single trend, all has to do with country have a lower external debt, so lower level of financing. They will be less badly affected by the current situation, whereas country who have a weak balance sheet, balance of payments, so they will have dependency, particularly on refinancing external debt, particularly if it's in a strong currency, call it US dollar. Even if dollars weaken over the last year, they will be affected more than other countries. So classifying one cluster is complicated.
From your point of view, how do high debt levels and limited fiscal room in developing economies exacerbate downside risks from subdued investments in the sovereign credit ratings?
Yeah. So this is a real problem. I mean, I remember when I was giving some interview just after the pandemic, without minimizing the tragedy that we had, let's put it this way, with the pandemic, I was saying the real virus that will be of the 2020s, so the year from 2021 onwards, provided the pandemic, thank God, was put aside quite fast, has been, it is, it will be debt. We had a huge increase in debt everywhere, from US to China to Japan to Europe, and that's obviously it's a problem. At some point it will be repaid. This is not can be rolled over forever, and obviously give less room for fiscal policy. So clearly Europe, for example, relieve but part of the stringent condition on the amount of deficit that in theory shouldn't exceed 3% of GDP. Now they've been allowed many countries to do that, will be much more than the 5%. US ran a deficit that was the biggest after World War II in non the period of war. So Japan has announced a $255 billion deficit that, even though in absolute terms doesn't seem big, is actually 3% further in addition debt to deficit to GDP. So we are talking about that, yes, in theory there is less fiscal room, but actually most countries are going for a big fiscal spending. That is good. It's good for GDP. It's good for market. But don't forget that we are going to see a market that it won't be, as is called, a beta market, where everything will go up, index will be up, will be dependent on quality of earnings, dependent on quality of balance sheet of companies. So it will be a stock pickers market. There will be winner and loser. There will be dispersion. There will be lower correlation and volatility. That's a key element for investing in 2026.
Right. From London, that was CEO of QW Capital, Gianluca Lobefalo. Thank you so much for your insights here. And back to our news and moving on to Europe. The Statis has reported that German exports unexpectedly fell in November, while industrial output showed modest gains, reflecting both global challenges and slight domestic improvement. Exports dropped 2.5% and imports rose 0.8% on a calendar and seasonally adjusted basis compared with October 2025. Provisional data showed exports down 0.8% and imports up 5.4%. Germany exported 128.1 billion euros and imported 115.1 billion euros in November, resulting in a trade surplus of 13.1 billion euros, down from 17.2 billion euros in October 2025 and 20 billion euros in November 2024. And in Asia, National Bureau of Statistics data has shown that China's consumer price inflation hit a 34-month high in December, though the full-year rate fell to a 16-year low, supporting expectations of further stimulus to boost soft demand. The Consumer Price Index, CPI, rose 0.8% year-on-year in December, with the core CPI, excluding food and energy, up 1.2%. Urban CPI increased 0.9%, rural CPI 0.6%, food prices rose 1.1%, and non-food prices 0.8%. Consumer goods prices were up 1% and services 0.6%. For all of 2025, CPI remained flat compared to 2024. In North America, statistics, Canada has reported that the country created just 8,200 net new jobs in December after 3 months of outsized gains, and the unemployment rate rose to 6.8% from 6.5% as more people searched for work. However, there were 1.55 million people unemployed in December, an increase of 72,900 or 4.9% from November. Data also showed that full-time employment rose by 50,200 in December, while part-time employment fell by 42,000. Moreover, the average hourly wage of permanent employees, a gauge closely tracked by the Bank of Canada to ascertain inflationary trends, rose by 3.7%, down from 4% in November. And to the United States, the Labor Department has reported that U.S. job growth slowed more than expected in December amid business caution about hiring because of import tariffs and rising artificial intelligence investments. But the unemployment rate dipped to 4.4%, supporting expectations the Federal Reserve would leave interest rates unchanged this month. Non-farm payrolls increased by 50,000 jobs last month after rising by a downwardly revised 56,000 in November. Data also showed that U.S. employers added 584,000 over the course of 2025, the first year of Trump's second term. The Commerce Department has reported that the U.S. trade deficit narrowed sharply in October, falling 39% to $29.4 billion, the lowest level since June 2009. As imports declined, imports fell 3.2% to $331.4 billion, with goods imports down 4.5% to their lowest since June 2023. Consumer goods imports plunged, led by a sharp drop in pharmaceuticals, while industrial supplies also declined. Capital goods imports, however, rose. Meanwhile, exports climbed 2.6% to a record $302 billion, with goods exports hitting an all-time high. The goods trade deficit narrowed 24.5% to $59.1 billion, the smallest since March 2026. Additionally, the Commerce Department has revealed that U.S. wholesale inventories rose again in October, increasing 0.2% after a 0.5% gain in September, suggesting inventories could contribute to fourth quarter GDP after dragging growth for 2 consecutive quarters. The report, delayed by a 43-day government shutdown, showed inventories up 1.7% from a year earlier. Wholesale sales fell 0.4% in October, following a 0.2% decline in September. At the current sales pace, it would take 1.3 months to clear inventory, slightly up from 1.29 months in September. Moody's Ratings has warned that President Trump's proposed 2027 defense spending increase is unlikely to be offset by savings or revenue, potentially worsening already large U.S. fiscal deficit. Senior Vice President of Moody's Sovereign Risk Group, David Rogovich, noted that sustained debt finance spending would widen deficit, raise the interest burden, and limit fiscal flexibility. He added that while higher defense spending could boost GDP growth, the resulting government revenue would not cover the increased costs. U.S. President Trump has directed his representatives to purchase $200 billion in mortgage bonds, stating that the move will lower rates and monthly payments. In a Truth Social post, he said the directive targets Fannie Mae and Freddie Mac, which he described as flush with cash. Trump added that the measure would help restore affordability, a term central to Democrats' criticism of his handling of high prices. Italian Prime Minister Giorgia Meloni has announced government plans to spend around €1 billion to curb energy bills for families and firms as part of efforts to boost economic growth. The Prime Minister cited focus on growth and security when outlining her policy plans for 2026. Meloni noted that the Statistics Bureau Istat was underestimating Italian economic growth. She also expected an upward revision of gross domestic product data for 2024 and 2025, suggesting the same adjustment could occur for both years. Meta Platforms has signed 20-year agreements to purchase power from 3 Western nuclear plants in Ohio and Pennsylvania, and to help develop small modular reactors with Oklo and TerraPower. The deals will support expansion and lifespan extensions at Vestas Perry, Davis Besse, and Beaver Valley plants, licensed through at least 2036, with one Beaver Valley reactor licensed through 2047. Meta said the agreements could provide up to 6.6 gigawatt of nuclear power by 2035, with its partnership with Oklo expected to deliver up to 1.2 gigawatt in Ohio as early as 2030. Oil prices rose on Friday on concerns about potential disruption to Iran's output and uncertainty about supply from Venezuela. Brent futures were up 0.8% to $62.49 per barrel, while U.S. West Texas Intermediate crude was up 0.9% to $58.27. Both benchmarks climbed more than 3% on Thursday, following 2 straight days of decline. For the week, Brent is on track to climb 3%, while the WTI has gained 1.8%. Goldman Sachs has raised the copper price forecast for the first half of 2026 to $12,750 a metric ton from $11,525 a ton, citing a scarcity premium amid limited inventory coverage outside the United States. The bank, however, noted that a second quarter tariff announced could signal an end to U.S. stockpiling and bringing oversupplied global fundamentals back into focus. Moreover, Goldman Sachs maintained its quarter 4 2026 forecast of $11,200 a ton and added that it does not expect the price above $13,000 to be sustained. Fidelity Gold Refinery, the FGR, has revealed that Zimbabwe's gold production rose by 17% to reach an all-time high of 46.7 tons in 2025, up from 36.48 tons in 2024. Data also showed that artisanal and small-scale miners delivered 34.9 tons to the country's sole gold buyer, while large-scale mines supplied 11.8 tons. FGR Chief Executive Officer noted that record-breaking output was driven by strong global gold prices and favorable government policies that supported the mining industry, a key sector in Zimbabwe's economy. And gold prices rose on Friday and were on track for a weekly gain as investors weighed weaker than expected U.S. payroll data, along with broader policy and geopolitical uncertainty. Spot gold was up 0.2% at $4,485.73 per ounce and was set for an about 3.8% weekly gain. Bullion hit a record high of $4,549.71 on December 26. U.S. gold futures for February firmed 0.5% to $4,483. In other metals, spot silver gained 2% to $78.42 per ounce and was on track to log an about 8.8% weekly rise. JP Morgan's Global Head of Advisory and M&A, Arno Eininger, has stated that deal makers are poised for a strong 2026 with a record number of deals in the pipeline as CEOs seek the stability of scale amid rising economic and geopolitical risks. She noted that shocks from technology disruption and AI to supply chains, energy, and geopolitics are widespread, and who added that larger companies can better withstand volatility because they have more levers to pull. And global stock markets showed a collective gain across all indices during Friday's sessions. In the US, the S&P 500 was up 0.44%, the Dow Jones Industrial Average increased 0.3%, and the Nasdaq gained 0.61%. In Europe, the UK's FTSE 100 jumped 0.89%, France CAC 40 soared 1.32%. Moreover, Germany DAX hiked 0.51%. In Asia, the Shanghai Composite surged 0.92%. Japan's Nikkei 225 climbed 1.61%, and Hong Kong's Hang Seng rose 0.32%. And that brings us to the end of our economic news bulletin. But before we wrap up, here is a quick recap of what we've been covering. UN predicts slow economic growth in 2026. Moody's warns Trump defense budget plan could widen deficits. And Italy to spend around €1 billion to curb energy bills. That's all for today's Economic News Roundup. Thank you for joining us, and stay informed, stay ahead, and we will be back with the latest updates tomorrow. Don't forget to follow Qnews on YouTube, Facebook, X, Instagram, and TikTok at Qnews to stay informed.